Hi everyone, welcome to our 30th of June edition of the Catapult Wealth Update. Only 6 weeks to go to the 30th of June, and it's that time of year where everyone scrambles around trying to work out what deductions they can have and how they best maximise their tax outcome. Today I just wanted to talk about 5 or 6 key things, particularly around superannuation, that we'll be talking to our clients about to do or look at doing before the 30th of June. Firstly, just this year has been a fantastic year for superannuation returns. The equity markets have been fantastic, and therefore people will, in general, be much happier with the outcomes for this 30th of June. Certainly has been a lot better than the previous 3 or 4 years. The first thing that we'll talk about today is just make sure that if you've got to make a contribution to superannuation to claim a tax deduction for those, particularly for those self-employed people, make sure you do it. You're allowed up to $25,000 per person as a concessional contribution to make into superannuation. Get it in, make sure you do that, and don't wait till the 28th of June to do that. The money's got to be in super and cleared to be able to claim the tax deduction. Interestingly, the government's going to change this slightly, this limit for those that are over 60, as at in the 13-14 year. That limit will change from 25 grand up to 35 grand, which is nice for those that are in that particular category. Secondly, I guess making sure that you put your concessional contribution in, or your will help lower your taxable income. That if you've got any other income like capital gains income in the financial year, it'll help lower your overall tax rate. Second thing that I would particularly point out, make sure you know your contribution rules. Make sure that you understand how much you contribute on a concessional basis, how much you can contribute tax-free, which is called a non-concessional contribution. Really important that you know those rules, because if you breach them, the government and the ATO have been particularly harsh on dealing with people who don't operate within these limits, and certainly something that I would encourage clients to understand these contributions rules. And on that note, if you're unsure about it, please ring us here at Catapult Wealth to make sure you're on the right track. Third tip this year, and it's going to be important this year and next year, is going to be even up your super balances. The government is looking at introducing a rule where up to $100,000 worth of income per member in your super fund is tax-free. Over $100,000 is going to be taxable at 15%. So it's important that not all the assets and the superannuation balances in one partner's name. Where possible, you've got to look at evening that up. That will involve perhaps doing some strategies around taking money out and putting it back in. And once again, think carefully and talk to your advisor about how to do that. Fourthly, just remember to review your salary sacrifice arrangements. Salary sacrifice, for those that are doing it, are putting in an amount per fortnight or per month with their pay packets. You get to this time of year, and if you don't want to misjudge what you've done, because you're only allowed 25 grand of salary sacrifice money, if you are through a pay rise or through a bonus or through some form of pay increase, you may exceed this 25 grand, you're going to get taxed, and there's going to be an excess tax paid on that. So make sure you review your salary sacrifice arrangements. If you're starting to get close to your limit, stop salary sacrificing and then restart it again in the new financial year. Really important, just a little tip at this end of the financial year. Number 5 is to just review, if you're in pension phase in your super fund, doubly make sure, triply make sure that you've taken your minimum pensions out for the financial year. If you don't do this, your pension account will transfer back into super mode, and you'll be taxed on 15% of the earnings instead of the earnings being tax-free. Make sure that you perhaps even allow a few dollars in terms over your minimum, just so you know that you've got it right. This is crucial and something you just don't want to get wrong. Last thing, number 6 on our list today, is just to make sure that if you've got some capital gains throughout the year because the markets have been strong, you've taken some trading profits. If you've got a couple of laggards or a couple of resource stocks that haven't performed as well, perhaps you may look at selling a couple of those to crystallise the losses, and perhaps buying other stocks with the money. Certainly wouldn't encourage you selling shares and rebuying them straight away, because that will be seen as tax evasion, but crystallising some losses and dealing with it in a sensible format would certainly help manage your tax outcomes for this financial year. Hope some of these tips have helped. As usual, if in doubt, ring us here at Catapult Wealth. We're more than happy to help you.